Today I'm going to discuss moving averages with you, and so this is for beginning traders. This should be one of your very first lessons when it comes to technical analysis, and so it's going to be very critical if you don't know much about moving averages. The first thing that I will discuss are the moving averages that I use, which are the 10, 50, and 200, and you'll understand that in a minute. Then we will talk about a simple moving average, or SMA, versus the exponential moving average. And then I will just basically go into how to use them. So I'll give you a couple of examples. So let me just pull up a chart that I have. Okay, I have the VXX chart, and it really doesn't matter. I had this from earlier today. But as you see, this is a chart. We can pull up any other chart. A lot of you like to do things like Google, Apple. So let me just pull up Google, and I will pull up the daily chart. It really doesn't matter. Okay, but let me just use this one. Now I have 3 lines here that are sloping up. The red one is the 200 moving average. The blue one that I have is the 50 moving average, and this orange line here is the 10 moving average. Now, as far as moving averages, you can either have a simple moving average or an exponential moving average. Now, moving averages, really, I have to define what they are. They basically take your chart and they calculate a certain time period, okay, and they take out the average. So that will be the simple moving average. And so, for example, if I have this 50 moving average, this blue line here, and it's around $889.95. So this value, where it is on this candle, will tell me the average of the last 50 candles, and that's why we call it a 50 moving average. So it takes the average of the last 50 candles, and it gives me a value, a dynamic value. This value always changes with every candle, so it might go up or down. Now, since I'm using the daily chart, the 50 moving average is going to use the average of the last 50 trading days. You can also use, this on a 1-minute chart, 10-minute chart, weekly chart. It doesn't matter. It just gives you the average of the last 50 candles, whatever your candle spans. It doesn't matter as far as the time period. Okay, so that would be the simple moving average. The exponential moving average, which I don't use, but you could use it. It just basically means that the further away, okay, in time, a value is, the more it deteriorates. So it's the same thing. It kind of takes into account the last 50 sessions, the last 50 days or candles, but it gives the more frequent ones a higher value than the ones that are, far out here from, let's say, a month ago or so. So it's exponential. So we're saying, if you can imagine a graph, okay, something that is more recent will be higher on the graph, and then as we go further into the past, okay, it goes down exponentially. So we call it an exponential moving average. I don't use that one. I use a simple moving average. In a simple moving average, every candle has equal value, okay, and the purpose is to really tell you a trend, okay. And so if a moving average is sloping up, we assume that this stock is in a bullish trend, that it will go up. And if it's sloping down, we assume that it's in a bearish trend, and it's been in that trend for a while. And then if your chart at this time is also supporting that direction, then you can basically say, well, this is a bullish trend or it's a bearish trend. So you use the chart as well as the moving averages to establish what kind of trend you are in. Now let me just kind of give you an example of how moving averages can be support or resistance. So obviously if we just look at today, you have the 50 moving average, that's support. Now it's not really major support, because if you're hovering around the same moving average for days and weeks, it's not strong support. The strongest support is when your chart comes into a moving average unexpectedly. Okay, and so my 200 moving average is going to stop here. But here's a good example on the daily. So if you look at the 50, which is the blue, notice how here the stock started selling off and it found support at the 50 moving average. So usually when a stock comes into a moving average after it has been away from it for a long time, so you see how it's been away from the blue line for a long time, if it comes into it, it's usually a very strong support. And lo and behold, the next day we gapped up. So this can be a good indicator. Now if we go back, okay, also another thing, if a stock tends to pass over a moving average, okay, and then it stays there for some time and comes back, okay, that just basically means a strong support. So here you notice that it passed and it had these green candles, so this would have been a very strong surge away from the 50 MA, and so you use this here, when it was time here for support, that would have told you that this 50 moving average was strong support. And also here as another example, this moving average here was also support, right? Now here it would have been resistance. Okay, so let's put that into context of the 50 moving average. Okay, so notice how here we basically just cut through this 50 moving average. So this was very, very strong. Okay, this was very, very strong on high volume. Okay, so now you came back here and this blue line, this 50 moving average, served as resistance, and lo and behold, we went down. Now if you look at this orange one, the 10 moving average, you will notice that a stock rarely gets far away from this moving average, from this orange moving average. And maybe it's not the best color, okay, but notice how, I'll just draw it for you here, notice how the stock tends to follow this moving average, this 10 moving average. Now you may use another time frame, so I'm using just the 10-day. Some people use the 8-day, others use the 15. But usually these short term, okay, moving averages, if you use whatever you want, but usually your stock will follow these short term moving averages. And notice how you can see these trends, how here we entered a trend around the 17th of July in 2012, and it has the stock has pretty much remained above this 10 moving average, okay, all the way until October, until it finally broke. Okay, but the point is that a stock rarely gets away from this moving average, so it wasn't too long until the stock basically recovered. And so you can use your short-term moving averages to kind of see if your stock is deviating away too far. So notice how here we gapped up, but it couldn't stay up too long. Why? Because we are deviating from all these moving averages. Stocks do not like to deviate too much away from moving averages. Just like it did here and found support, it had to go back up, and here it gapped up, but it had to basically go back and find its shore. Okay, so the moving averages are sort of like a shore. Notice also here how we stayed up, but eventually we had to come back down. Here the 50 MA was serving as support. Okay, now let me pull up another chart so you don't think I'm only looking at Google. Let me see if we can find something on JPM. JPM, I have a lot of drawings here, so you'll have to ignore that. But JPM basically today, okay, closed on a moving average, okay, but it's been around this moving average for 3 days, and so now a good question would be, is this going to be good support? Usually the more times a stock will hit a moving average, the less likely it will serve as support or resistance. So it's kind of like breaking glass, right? You have to basically throw something at it a couple of times before it breaks. But if we go back on JPM, notice how here we had a doji, but it had to recover because it was underneath this 50 MA. Okay, and now just FYI, not every stock is the same. Okay, so usually you'll have to trade a ticker symbol, for a couple of months and then get a feel for it. So, JPM is not going to trade the same way as Google, but for the most part, they tend to follow the same rules. So, as we see, JPM had a lot of sideways trading, and I'm glad that I pulled up this chart actually, because I have something drawn in here. So I have drawn in this trend here, or channel, and notice how the moving averages are very close, okay, within this range. And usually you can, if you want to, you can also draw these channels. Basically just draw, support and resistance and trend lines. I won't go into that in this video, but just know that these moving averages tend to stay around these channels, and they basically just support the trend. That's what I'm trying to say. And let's see if we find anything in my scribble here. Okay, so we found some support here, as you can see. Found some support right here. Okay. Now JPM hasn't had a lot of resistance, so notice how it's above the moving averages. And so most of it would have been bounces along support line. So here another support line. Okay, now just one little secret: bounces off of the 200 MA are usually the stronger bounces, and they're the ones that establish really strong trends. So notice the red line is my 200 MA. So let's put this into context. So here it bounced off back in September 2012, basically had a really strong rally. So again, this just goes to show us how, when something breaks out of the 200 MA, it tends to have a strong rally. And then it basically based sideways. And then in November 2012, it came into this support, into this 200 MA, which is strong support. So remember, 200 MAs are your strongest supports of these moving averages. And see what happened. So in November 2012, we had support at the 200 MA, and let's follow the 200 MA, and to this day, okay, and it's July, almost August 2013, we haven't touched the 200 MA. So we've had this very, very strong rally off of the 200 MA, which started here. Let me just try to make that pretty for you, the best that I can at least. So the 200 MA would have bounced right here. Give me just one moment. I'm not used to my charts being this small, but I have to do it for the video. Okay, so here in November we were around $39, and we had a really strong rally, and now we are around $56. So if you're a beginner and you're looking for some really easy chart patterns, you really don't want to look into anything complicated, my advice to you is to look for these charts that have been away from the 200 MA for a long time, and when they finally come into the 200 moving average, and I'm talking about a simple moving average, when they finally come into this moving average, see if maybe you can support your findings, so you're not only basing your trade off of a 200 MA, but usually when you have these 200 MAs, we get strong bounces. So my advice to you is to put this in your arsenal if you're a beginning trader. Bounces off of 200 moving averages like this are usually very good bounces, but you do need to support them with other indicators and other reasons as well.